The mystery behind Warren Buffett's investment strategy. Ever wondered how Warren Buffett became one of the world's wealthiest individuals? With a fortune surpassing $130.8 billion USD as of 2024, he's not just rich, but also famous for his investment prowess. So what's the secret to his success? Let's unravel the mystery behind Buffett's financial genius. Warren Buffett. History. Warren Buffett was born in Omaha in 1930, and from a young age, he was into business and investing, especially the stock market. He kicked off his education at the Wharton School and then got his bachelor's degree in business administration from the University of Nebraska. After that, he headed to Columbia Business School for his master's in economics. In the early 1950s, Buffett started his career in investment sales and later founded Buffett Associates in 1956. Believe it or not, less than 10 years later, he was running Berkshire Hathaway by 1965. Then, in June 2006, Buffett made headlines by announcing he would give away his entire fortune to charity. Alongside Bill Gates, he launched the Giving Pledge campaign in 2010 to inspire other rich people to do the same. If you are excited to know about Warren Buffett's investment strategies, stick around until the end of the video, and don't forget to hit that like button and subscribe. Buffett's investment philosophy. Buffett is a big fan of the Benjamin Graham School of Value Investing. This means he looks for stocks that are selling for less than they're worth. But how do you figure out what something is worth? Well, there's no one-size-fits-all method, but usually you analyze a company's basics to get an idea. Here's where Buffett stands out. While many value investors don't fully buy into the efficient market hypothesis, EMH, which says that stocks always trade at their fair value, Buffett takes it to the next level. He's all about finding those diamonds in the rough, those stocks that the market hasn't caught on to yet. He believes that even though the market might not recognize their value right away, eventually it'll come round. Buffett has a unique take on the stock market. Unlike many investors who closely follow its ups and downs, he's not too bothered by short-term fluctuations. He famously said that in the short term, the market behaves like a voting machine. But in the long term, it acts like a weighing machine. When Buffett picks stocks, he's not playing the short-term game for quick gains. Instead, he looks at the big picture of each company. He wants to own shares in businesses with strong potential to make money over time, regardless of market sentiment. For him, it's all about investing in quality companies capable of generating solid earnings, rather than worrying about whether the market will catch on to their value. Have you ever made any investment and how it went? Let us know in the comments section below. Buffett's investment tips. As we move forward, let's take a look at Warren Buffett investment tips. 1. Wait, then pounce. Wait, then pounce is Buffett's sage advice when it comes to investing in a promising company. Instead of rushing in headfirst, he recommends taking a moment to assess the situation calmly. Buffett suggests waiting for the stock to reach a reasonable price before making your move. This patient approach allows you to capitalize on market corrections and make more informed investment decisions. 2. Stay the course. Once you've waited for the right opportunity and made your move, Buffett advises against panicking when your investments hit rough patches. Because they will. Instead of selling in a panic, he encourages a different approach. Keep buying. In a CNBC interview, Buffett emphasized his confidence in the long-term success of American businesses, suggesting that despite temporary setbacks, the overall investment landscape will thrive over time. Do you know Buffett skipped investing in Google and Amazon because he didn't understand the internet industry? He believes in investing in what he knows best. Even though these companies became successful, he stayed away because he couldn't analyze them properly. This shows his commitment to investing wisely. 3. Pick businesses, not stocks. Buffett stresses the importance of thoroughly understanding the business behind a stock before investing. Focus on industries you know well to accurately assess a company's trajectory, not just its current state. This approach requires patience and a willingness to educate yourself, especially if you encounter an intriguing opportunity in an unfamiliar field. Take the time to delve into balance sheets and expand your knowledge. Additionally, Buffett recommends adopting a long-term mindset when it comes to stock ownership. He advises planning to hold onto a stock for at least 10 years, if not longer, allowing the business ample time to grow and evolve. As he put it in his 1996 letter to Berkshire Hathaway shareholders, If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Buffett's methodology. Warren Buffett searches for cheap stocks by asking himself a few questions about their quality and price. But he doesn't stop there. Here's a rundown of his 6-step investment approach. 1. Company performance. Return on equity, ROE, measures how much profit a company generates for each dollar of shareholders' equity. Buffett checks return on equity to gauge how well a company has performed compared to others in its industry. To calculate return on equity, divide the net income by the shareholders' equity and multiply by 100. It's essential to look at return on equity over 5 to 10 years to understand historical performance accurately. 2. Company debt. Buffett pays close attention to the debt-to-equity, D/E, ratio. He prefers companies with minimal debt, relying on earnings growth from shareholders' equity rather than borrowed money. To calculate the debt-to-equity ratio, divide total liabilities by shareholders' equity. This ratio reveals how much of a company's assets are financed by debt compared to equity. A higher ratio means more debt is financing the company, which can lead to unpredictable earnings and hefty interest expenses. Some investors use only long-term debt for a stricter evaluation. 3. Profit margins. A company's profit margin, calculated by dividing net income by net sales, is crucial for its profitability. It's not just about having a good margin. Consistent increases are vital too. Investors should examine profit margins over at least 5 years to gauge historical performance accurately. A high profit margin signals effective business execution. Steadily increasing margins suggest that management has been efficient in controlling expenses, leading to improved profitability over time. 4. Is the company public? Buffett typically sticks to companies with at least a decade of history, which means many tech startups from the past 10 years don't catch his eye. He's admitted he doesn't fully grasp the workings of many tech firms and only invests in what he understands. For Buffett, value investing means finding established companies that are currently undervalued. Historical performance is crucial. It shows whether a company has consistently created value for shareholders. However, past success doesn't guarantee future gains. As a value investor, Buffett's skill lies in predicting the company's future performance. It's a tricky task, but one he's mastered over time. Public companies must regularly file financial statements with the Securities and Exchange Commission, SEC. These statements provide valuable data for investors to analyze a company's past and current performance, aiding in investment decisions. 5. Commodity reliance. At first, you might find this question unusual, but Buffett considers it crucial. He tends to avoid companies with generic products or those solely reliant on commodities like oil or gas, although there are exceptions. For Buffett, a company must offer something unique to stand out from competitors in the same industry. He calls this unique characteristic a protective moat, which gives the company a competitive edge. The wider the moat, the harder it is for rivals to steal market share. 6. Is it cheap? Here's the catch. While finding companies that meet the first 5 criteria is important, determining if they're undervalued is the toughest part of value investing. And it's Buffett's most critical skill. To gauge a company's true worth, an investor must analyze various business fundamentals like earnings, revenues, and assets. The intrinsic value of a company, which is typically higher and more complex than its liquidation value, reflects its total value beyond just its physical assets. Liquidation value doesn't consider intangibles like brand value, which aren't directly stated on financial statements. Once Buffett calculates a company's intrinsic value, he compares it to its current market capitalization or its total worth. Seems straightforward, right? But Buffett's success hinges on his unmatched ability to accurately determine intrinsic value. While we can outline his criteria, we can't fully grasp how he's mastered this skill with such precision. Buffett's investing style is like a bargain hunter's approach to shopping, practical and down to earth. He applies this mindset to his lifestyle too, living modestly without fancy houses or cars. While some may criticize his approach, his success proves its worth, whether you're a fan of Buffett or not. If you enjoyed today's video, why not share it with your friends? Give it a thumbs up and subscribe for more content like this. Are you intrigued to know more about Jeff Bezos' fascinating life? If so, we've got just the video for you. Or are you interested in a video like this one? We've got ready for you. Just hit play and enjoy.